Dan, I asked a guest last hour about the SPAC, saying, is it simply a bad deal because the sponsors take 20%? And he said, well, they only take 20% if they perform well, so their interests are aligned with shareholders. What's your response to that?
I don't think they're necessarily a bad deal. It's all about the actual underlying company they bought. If it's a good, strong company, then it's a good deal. If it's a weak, maybe specious company, then it's a bad deal. And I think the reality with these SPACs, part of it is so many companies that have gone public via SPAC are pre-revenue, not like biotech, but pre-revenue tech companies. So they come out with earnings quarter after quarter, but there are no earnings, there are no revenues. So it's really a science project update. And I think that's gotten some investors a little bit nervous.
The SEC, though, has cracked down on this, Cameron, correct? So the things you can do with SPACs now are different than they might have been 6 or 12 months ago?
Yeah, correct. I think they're rethinking some of these long-term expectations that are able to be used in SPAC acquisitions, and I think that could cut down on some of the bringing some of these companies that are maybe not ready to be public into the market that a lot of SPACs maybe earlier this year were doing.
Dan, let me go back to this question about what the sponsors take. I'm just going to repeat it. Is it a bad deal? I mean, that is a huge amount of capital to walk away with from people like Chamath or Bill Ackman or well-known names who it feels like they get paid either way, and then the performance just doesn't pay off for the investors who get involved after the fact. Is this simply an unfair way to paint what's going on here?
In a vacuum, sure, but look what we're comparing it against, right? You might be comparing it against companies that would stay private longer for another 1, 2, 3, or 4 years. So it'd be the venture capitalists, the private market investors who would get that, and the public market shareholders would never get to touch any of that upside. Or go public via an IPO, a traditional IPO, in which kind of the high net worth clients of the banks get in at the IPO price. Everyone else gets in a few bucks higher. So that's not a great deal for you either. You could argue there is not necessarily a wonderful deal, generally speaking, for retail investors who are getting into newly public companies or high growth tech startups. This is another way that the flip of that is you can usually get these at $10 a share. And if it's a good company, it should go up higher.
Cameron, let me ask you a question about sort of the IPO pipeline out there. We just had Bob Pisani on talking about all these IPOs that are coming up in the coming time period. All of them, consumer-facing brands. You talk about, yogurt company. I had a yogurt this morning. I can relate to that company. As an IPO investor, do you want to put those consumer-facing brands out there for the public and the Reddit crowd that might latch on to some of those familiar brand names as opposed to going the SPAC route?
Yeah, I think there's benefits for companies to go public, whether it is via SPAC or traditional IPO. I think it's all about the company's perspective on what's going to get them the best price, what's going to dilute, existing shareholders the least, and then maximize value long term. So if the incentives are aligned between the SPAC sponsor and the company, I think that's obviously still an option for some of these companies. But I think for a company with an established brand, consumer facing, I think a direct listing or IPO is probably going to be the stronger option, and other companies that maybe have a little bit more difficult time breaching the public markets might choose the SPAC route.